I want to start with a number that came out this morning and that most investors are reading completely backwards. The number is 3.8. That is the April Consumer Price Index reading annualized 3.8%, the highest since May of 2023, above every forecast, above the Federal Reserve's own projections. And when that number hit the screens this morning, gold fell. It is sitting near $4,690 as I am recording this, down from its January all-time high of $5,589. Bombs are still falling in the Middle East. The Strait of Hormuz is still commercially disrupted. The Federal Reserve is still buying $40 billion per month in Treasury securities under a name that is not quantitative easing. And gold fell on a hot inflation print. So I want to ask you directly, do you understand why that is happening? Not the surface explanation that financial media gives you, the actual mechanism. Because if you do not understand the mechanism, you are going to read this morning's CPI print exactly the way the financial media wants you to read it, as evidence that the gold trade is broken. And you are going to make the most expensive mistake of this entire cycle. I have been studying how inflation data interacts with the gold price across 50 years of debt cycles. And what I am going to show you today is not an opinion. It is a mechanical sequence. Write this down, because once you understand why a hot inflation print drives gold down in the short term and what that same print means for gold over the next 12 to 24 months, you will never be surprised by this pattern again. Subscribe now. Let me start with the mechanism, because in 50 years of studying these cycles, the first lesson I learned is that the short-term price and the structural price of gold are almost always different things. The short-term price is set by three variables: the dollar index, the 10-year Treasury yield, and the level of speculative positioning in the futures and ETF markets. All three of those variables respond to an inflation print in the same direction simultaneously. Here is how it works. April CPI comes in at 3.8%, above forecast. The market immediately concludes that the Federal Reserve cannot cut rates in response to this print. Cannot. A central bank that is already holding rates at 3.5 to 3.75% against inflation running at 3.8% has negative real rates. Cutting into that environment would accelerate the inflation further. So the rate cut that the gold market was partially pricing, the cut that was supposed to reduce the opportunity cost of holding gold relative to Treasury bonds, disappears. The market reprices. Treasury yields rise as traders adjust their rate cut expectations. The dollar strengthens as higher yields attract capital into dollar-denominated assets, and gold, which pays no interest, no dividend, no yield of any kind, faces the mechanical headwind of a stronger dollar and higher yields simultaneously. The futures traders who were long gold unwind. The leveraged ETF products that retail investors poured $70 billion into throughout 2025 rebalance their positions daily. A modest unwind becomes a cascade, and gold falls, not because the structural case for gold has changed, because the short-term mechanical price has responded to a data point that made the short-term headwinds worse. This is the mechanism that is operating right now. This is why gold fell this morning on a hot inflation print. And this is the mechanism I have watched operate after every major inflation surprise in the past 50 years. The short-term price and the structural price diverge. They always reunite. The only question is when. Now I want to show you what the same 3.8% inflation print means for the structural price of gold, because this is the analysis that institutional research departments publish and that most retail investors never see. And once you see it, the hot CPI print transforms from a headwind into the most important confirmation signal of this entire gold cycle. Here is the structural reality that 3.8% inflation creates. The Federal Reserve is holding rates at 3.5 to 3.75%. Inflation is running at 3.8%. That means real interest rates, the rate you actually earn after subtracting inflation, are negative. Negative real rates. The holder of a treasury bond earning 3.75% annually while inflation runs at 3.8% is losing purchasing power every year they hold that bond. They are paying the government for the privilege of lending it money in real terms. Now ask yourself, in that environment, what is the opportunity cost of holding gold? Gold pays nothing, but neither does a treasury bond in real terms. When real yields are negative, the traditional argument against gold, that it pays no interest, loses its force. Because the alternative that supposedly does pay interest is actually paying negative real interest. This is the structural setup that gold requires to break decisively higher. Not low nominal rates, negative real rates. And 3.8% inflation against 3.75% nominal rates produces exactly that configuration. The hot CPI print that sent the short-term gold price lower this morning has simultaneously confirmed the structural condition that drives gold's long-term move higher. The investors who understand this distinction are not selling gold this morning. They are watching the short-term mechanical price fall and recognizing it as the accumulation window that the structural price has just opened. I want to give you the historical record of what happens to gold in the 12 to 24 months following a hot inflation print that kills rate cut expectations. Because history is the only honest test of any macro framework, and the record on this specific pattern is unambiguous. In 1973, the first OPEC oil shock pushed inflation above 10% and killed any possibility of Fed rate cuts. Gold initially sold off as the dollar strengthened and yields rose. Then over the following 24 months, gold rose 150%. In 1979, the second oil shock pushed inflation above 13%. The Fed under Paul Volcker was forced to raise rates dramatically. Gold initially fell as real yields spiked. Then it rose 276% in 12 months as the market concluded that the debt arithmetic of the time made Volcker's rates unsustainable indefinitely. In 2022, the post-pandemic inflation surge pushed CPI above 9%. The Fed hiked rates from 0 to 5%. Gold fell throughout the hiking cycle as real yields rose. Then, from the moment the market concluded the hiking cycle had peaked, gold rose from approximately $1,600 to its January 2026 all-time high of $5,589. Every single time. The hot inflation print kills rate cuts. Gold sells off short term. The structural conditions that the inflation created, negative real rates, fiscal pressure on a debt-laden government, accelerating de-dollarization by central banks who do not want to hold a currency being debased, those conditions build in the background while the short-term price falls. And then when the accumulation phase is complete, when the structural buyers have finished their patient acquisition of gold at prices, the headlines have told retail investors are broken, the structural price and the short-term price reunite violently. And the investors who sold at the bottom of the short-term sell-off are no longer holding what they need to be holding when that reunion occurs. Now, I want to show you why the 2026 version of this pattern is more structurally extreme than any of the historical precedents I just described, because the mechanism is the same in every cycle, but the underlying conditions that determine the magnitude of the eventual move are different in 2026 than they were in 1973, in 1979, or in 2022. Write this down, because this is the part that changes everything about how you should be reading this morning's CPI print. In 1973, when the first oil shock embedded inflation into the monetary system, the United States national debt was approximately $500 billion. The Federal Reserve could raise rates to 20% under Volcker in 1979 and break the inflationary cycle because the interest cost of that debt at 20%, while painful, was arithmetically survivable. Today, the United States national debt is $39 trillion. The interest cost at current rates of 3.5 to 3.75% is already $1.03 trillion annually, more than the entire defense budget. If the Federal Reserve raised rates to Volcker levels today, the annual interest cost on $39 trillion would approach $8 trillion. The entire federal discretionary budget is approximately $1.7 trillion. The arithmetic of a Volcker response in 2026 is not painful. It is impossible, which means the 3.8% inflation print that came out this morning has created a trap that the Federal Reserve in 2026 cannot escape the way the Federal Reserve of 1979 escaped it. The tool that broke inflation last time cannot be deployed at sufficient scale this time. And that constraint, the inability to raise rates enough to break the inflationary cycle against a $39 trillion debt load, is the precise condition that makes eventual monetary accommodation of this inflation mathematically inevitable. That accommodation, when it arrives, under whatever name the Federal Reserve chooses to give it, is what gold prices before the central bank announces it. And 3.8% inflation that cannot be broken by rate hikes is the confirmation that the accommodation is coming. Not this week, not this month, but within the time frame that the debt arithmetic requires. Let me close with the three signals I am personally watching to identify when the short-term mechanical price converges with the structural price. The first is the real yield on the 10-year Treasury, nominal yield minus inflation. 3.8% inflation against 3.75% nominal rates is already producing a negative real yield. When that configuration deepens, institutional rotation from treasuries into gold accelerates. The second is the Federal Reserve's language around its $40 billion monthly purchase program. When the Fed acknowledges it is serving a market support function rather than a technical balance sheet function, the monetization phase moves from quiet to official. The third is central bank gold demand. In Q1 2026, total gold demand reached 1,231 tons, worth a record $193 billion, up 74% year over year. That is not an anomaly. That is the third consecutive year of central banks buying gold at double the historical average while retail investors sell on hot inflation prints. There are two types of investors reading this morning's CPI print. The first type sees 3.8%, concludes rate cuts are dead, watches gold fall and sells. They are reading the short-term price. They are making the same mistake investors made in 1973 and 1979 and 2022. The second type understands that negative real yields, a Fed that cannot deploy a Volcker response against 39 trillion in debt, and central banks buying gold at record pace are not bearish for gold. They are the structural foundation for the next move higher. I have watched both types across 50 years of debt cycles. The hot inflation print did not break the gold thesis this morning. It confirmed it. Most investors do not understand the difference between the short-term price and the structural price. Now you do.